Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates. We are back in the studio. We've both had a bit of a break overseas, which has been nice, Ren.
Yes,
with me.
yes. You're looking very tan. I'm just a bit redder.
Yes.
But yes, we have been on holidays, and we are back from our 6-episode arc of Is There Money In with Ed Cavalier. A lot of fun and some very interesting topics. But we're back with Classic Equity Mates. We're back with an Ask an Advisor episode.
Yes, that's right, Ren. We had a great conversation with Glen Hare from Fox and Hare, answering many questions that had come in from the Equity Mates community. We covered superannuation, we covered investing, psychology of money, plenty of stuff covered in this episode. So firstly, a thank you to everyone who sent questions in. These are fast becoming a very popular episode amongst the Equity Mates community for good reason.
If you want to ask a question, ask@equitymates.com is the email address. Send us your question. We'll either ask it on one of these episodes of the podcast or in our Ask an Advisor email, which you can sign up to at the Equity Mates website. But Bryce, before we get into the show, we should introduce Glen. He's got a fascinating career. Before launching Fox and Hare, he was at Macquarie Bank for more than a decade. He worked in a number of roles from institutional broking to wealth management. He was actually one of the youngest directors in the company at the time when he left in mid-2017. He then went on to co-found Fox and Hare and has been voted among the top 50 advisors in Australia 3 years running. That's the beauty of the platform we've built. We get to speak to some of the best advisors in Australia.
That's it, Ren. And I certainly learned a lot in this episode. So I appreciate everyone sending their questions in because I'm getting a lot out of it. A quick reminder that...
we got you to rate yourself out of 10.
Yeah. And yes, anyway. So just a reminder that while we are licensed, we're not aware of personal circumstances and neither is Glen. So any information in this show is for education and entertainment purposes. Any advice is general advice only.
Now, Bryce, 2 quick things before we get into it. First of all, we released a book this week.
Yeah.
Don't Stress, Just Invest. Available in all good bookstores or online booksellers, wherever you buy books. Check it out. And if you enjoy this podcast, if you want to take the next step on your investing journey, we hope that book helps. And then finally, the first question you ask, you obviously had a little bit of inspiration while you were overseas because you're introducing a would you rather question. When you told me that you want to start doing would you rather, I thought it would be financial. Would you rather stocks or property, Bitcoin or Ethereum?
Nah.
But no, that is not what you're going for. So if people are wondering about the first question, this is Bryce's holiday inspiration.
It's just a classic opener. Anyway, we'll leave it there and I hope you enjoy the conversation with Glen. Glen, welcome to Equity Mates.
Thank you for having me.
So before we rip in, where I'm going to introduce a new segment, Would You Rather, for all of our experts.
A little nervous about this one, but we'll roll with it.
It's not like the drinking Would You Rather yet, but to kick off, would you rather have the ability to see 10 minutes into the future or 150 years into the future?
Wow, that is big.
It's good. It's good.
Can I pick when I'm looking into the future? Like, all right, now I want to look.
I think it's just at all times you have the ability to be like, I can see 10 minutes into the future or 150 years.
I'm going to go 10 minutes. I think 150 years would freak me out too much.
Yeah,
True.
10 minutes would be enough. I can make some smart decisions in that time and then move on.
What about you, Ren?
Well, so I was thinking 150 years, you would be able to see what the world looks like and then invest accordingly.
Yeah.
And I was like, okay, there's some money to be made that way. But if you could see 10 minutes into the future, you could get to 10 minutes before the end of a footy game and see who's going to win.
Totally.
And then live bet.
Well,
and so there's money to be made that way.
I guess the nuance here is, can you action anything by seeing in front that far? Do you know what I mean? Like, can you change the future?
By betting on it?
Well, if you can see 10 minutes in front and you're like, I don't like that, can you do something about it? Like you're in a social
might be able to,
situation.
yeah.
Oh, it's like, oh shit, I'm going to be hit by a car in 10 minutes.
Well, if all my research watching sci-fi movies is anything to go by, you just don't want to change too much.
Yeah.
Right? So if you ever get the opportunity, just don't change too much.
Yeah. You see 150 years into the future and everything's great, and then you do something, you look ahead and it's terrible, and then you know that you caused that.
Yeah, totally.
Yeah.
I think there's a documentary with Adam Sandler called Click that's got something along the lines of that.
Anyway, we have plenty of questions to get through today in our Ask an Advisor episode. And thank you to all of the community members, Equity Mates community, who have sent in questions for Glen. We've got a bunch to cover, crossing superannuation, investing, and then a whole heap of general. So we'll start on the general. And we were talking about this offline, Glen, and it's the conversation around, is an advisor worth it? Like, that's what it comes down to at the end of the day. There's this, this idea that, it's known that getting advice is objectively expensive. And for us, it's understanding when is it worth outlaying that cash.
So I'm going to start with a potentially controversial view.
Great.
And so I think the advice industry is not articulating the value of advice for a younger generation as well as they could be. And the reason I say that is the advice industry is very much focused on pre and post retirees. And that's not a bad thing, right? Like, there's a huge opportunity where people that are looking to move into that phase of their life, you need to be really conscious of how do you do that. And we were talking earlier, like the average age of an advice client, so someone that has a financial advisor is 58. So the whole premise behind what we do at Fox and Hare is work with a demographic that we feel the advice industry has broadly left behind. So our youngest member is 20, she just turned 24. Our older members are probably in their mid-40s. So we only work with those that are in that accumulation phase. So majority would be in their 30s, I'd say. And in terms of the cost, I'm really conscious of the fact it is an investment, but I'd really encourage people to consider it as an investment. And the reason I say that is because some of the decisions that you make in your 20s and 30s will have huge compounding impact on what your 30s, 40s and beyond looks like. And I want to be conscious that I'm not saying that all we need to do is plan for the future. We want to do the cool in the short term, but we also want to make sure that we're making clear progress towards the medium and the long term as well. So, an example might be if you're living at home, just started your corporate career, earning good money, you've got two options. You can either spend it all and blow it on stuff that you don't really care about, or you can start making some really smart decisions that are going to seriously set you up for the medium and long term. And
so then just to close that out, part of the question is around at what point is it worth going to see an advisor? And is there a number in terms of disposable income or free cash flow where you believe it's like we can make a difference or a meaningful impact given the cash flow that you have?
Yeah. So I'll answer that in two ways. So we were really we held a number of focus groups before launching the business, and we had a room full of our ideal members, and half the room said, put your fees on the website, otherwise I'm not going to reach out because I have no idea what I'm going to get charged. The other half of the room said, well, if you put that fee on the website and I don't really know what it is I'm going to get for that, I'm not going to reach out. So we went with the not putting our fees on the website. So when someone reaches out, we have a conversation in the first chat with them, which is free. In terms of where we believe we can show value, if you're in a position where you're able to save or potentially invest around $2,000 per month, then we can show value. And I'm very confident in saying that because that amount of money, you can in terms of what you do with those funds, it can have quite a considerable longer term impact. And another example might be we've had a number of members reach out with that have accumulated some bad debt. How you define bad debt, whether that be a car loan, credit cards, personal loans, etc. One example, one member reached out to us and had $103,000 worth of credit card debt.
Whoa.
He was paying $18,300 per year in interest.
Oh my God.
And when he first signed up, he said, Glenn, I'm about to pay my fee on the credit card that you're about to help me try and pay off. And my response to that was, if we don't work together, where are you going to be in 3 years' time? And he said, I'm going to be in the same position. So we've worked together for about 4 years. He's completely debt-free and he's just bought himself a $1.5 million apartment with his partner.
Wow.
Good case study.
Really good. And the advice was simple. It was a really clear...
Don't use credit.
Don't use credit. He's certainly changed his relationship with credit cards, but the advice was a cash flow strategy. But it was someone to hold him accountable to it, but it's also someone to share with him what the picture looks like beyond the debt. And that can sometimes be really hard to see if you are in that fairly lonely position, I would say. So Anyway, I'm going a bit off tangent, but
no, it's good. It's good. It's good to have that number in mind. I think for a lot of people who are in that position of being like, should I? Shouldn't I? Do I have enough money? Is it worth it?
Yeah, totally.
I think having that number from your point of view is handy.
You don't need to be old and rich. If you've got some disposable income to make some smart decisions, get cracking.
And if you're on your way to getting to that $2,000 a month free cash flow, the good news is you can send your questions to ask@equitymates.com, and we're going to put them to advisors that we get on the show. And in this case, we've got a number of questions, as Bryce said, a few specifically around superannuation and a number of general questions from the Equity Mates community. But we wanted to start, I guess we wanted to turn the tables a little bit and have you ask us some questions. Let's say Bryce and I go to your website, sign up for the free session, and we come to you. What are the sort of questions that you or any of your advisors would be asking us as potential clients to sort of, I guess, get a gauge of our financial situation?
Great. So I've got 3 go-to.
Okay.
I'm giving away all my secrets here.
Nice.
But
That's the point of these episodes.
Yes.
So I've got 3 go-to. So first, do you have any financial frustrations?
Interesting. That feels like an emotional question. Well, it is an emotional question. Financial frustrations. Okay. Housing affordability in Sydney and the ability to afford a house. That's frustrating.
That's the same thing, isn't it?
Yeah.
Do you have any, Ren?
Housing is the big stressor, I think. Well, not stressor, but frustration. Yeah.
Okay.
Yeah.
Greatest financial aspirations?
The ability to
own a house.
Yeah. Fairly common one.
the ability to feel the ability to rely on my assets to generate enough income so that I don't have to rely on a paycheck from someone else.
Yeah. And do you know what that figure is?
No. As big as possible.
As big as possible.
I've never done the number. I've never crunched it to.
Yeah.
I'm just in the let's just get it as big as possible right now phase. Yeah.
Well, I mean, it would change. Like your circumstances would change. You have a kid, all of a sudden that number becomes a lot bigger. Yeah.
Yeah. And the aspiration ones, again, the general conversations when reaching out to an advisor is, what are your goals and aspirations? And for someone that's in their 20s, 30s, even 40s, 50s, like it's really hard to define what your goals are. And the reality is we often then see people put decisions around their financial well-being or the financial decisions they make on the back burner because they're not really sure what they're driving towards. Whereas if we think about our careers and our businesses and our things like that, like we know what success will look like. We know if we've had a good month, we know if we've had a good quarter, we know if we're hitting our KPIs. We often don't put that same lens when thinking about our financial goals. So we often encourage members to think about, what position would you like to be in? What are some of the things you'd like to consider doing? So potentially softening the language and the theme around aspirations and some of the key kind of responses that we often get. I want financial security. I want financial stability. I want financial freedom. I want financial flexibility. The lead on question, and that certainly doesn't come out in the first conversation, is then, how do we define that for you? But anyway, the third question that I would ask in a first chat is, how would you rate your overall financial world in terms of driving towards those aspirations? 10, you're nailing it, you're absolutely killing it, you're all over it. 0, you're the other side of the spectrum.
This is for me probably why I would want to go to an advisor, because the other two, I think for me, I don't know, 6.
6? Okay.
Yeah.
You once told me on this podcast that you couldn't save any more, that you had perfect cash flow.
I think you misconstrued what I said.
We'll look through the archives.
I think for me though, it's like going to see an advisor is where I'm not fully versed and want to know more on like, how should I be maximizing my cash flow when it comes to like super contributions and the first home buyer scheme thing and insurance and all those things that I feel like the saving part and the cash flow part, to Ren's point, I think I'm confident with. But it's then like, with what's left, am I actually really maximizing this for the goals that,
Totally.
It's not just setting it up and putting it into investments kind of thing.
Yeah, and 6 isn't a bad score, right? You're like, yeah, cool, I'm in the middle. But my challenge to you would be, what's going to get you to a 7? What's going to get you to an 8? Like where's the shortfall? And whether someone responds 8 or they say, oh, I'm probably 1, my lead on question is always the same. Okay, you're 1, what's going to get you to 5? You're 6, what's going to get you to 7? That's the exciting bit. That's the sweet spot where we can then delve into that and go, okay, cool, this is what's going to then enable you to move forward.
Here's a follow-on question then. How do you know if you're getting bad advice?
Oh, that is a good question.
That is a good question. How do you know?
There's a lot of trust implied in...
Totally.
And it's we're in a fortunate position, I think, that where we would go in with a level of base understanding of, given the work that we're doing on this show.
Yeah.
But someone who's going in with a 1 out of 10.
We had someone DM us. We did a 3-part series on superannuation.
Yeah.
And they DM'd us and they said, really like the series. I have a financial advisor. I'm in my 20s and my advisor had 60% of my super in cash. And that is a classic example of bad advice. But to Bryce's point, there's a level of trust.
General
there.
advice only, but maybe look into that.
Yeah.
Really, really good call out. And it is a trusted relationship, right? Like you're paying fees, you're expecting to get, good advice. How do you know if you're getting bad advice? It needs to feel right, and the advisor needs to explain to you very clearly how this is the right advice and putting you in a better position. And really conscious of the fact, as you kind of alluded to, Bryce, everyone reaches out to us with very different degrees of financial literacy. One of the things that we're very passionate about is empowering our members through education. So I think, and I'm hoping this doesn't happen as much anymore, but an advisor would sit across the table from their client and try and not give too much away because they wanted to be seen as the expert. Oh, I know everything. Like, you just need to trust what I'm telling you. We completely flip that on its head. We believe that the more that our members understand their strategy, the more likely they are going to then stick to the strategy because they understand the implications of the strategy and then inevitably achieve their goals. So if you're seeing an advisor and you don't understand the advice that's being put in front of you, challenge it and make sure that you're asking questions constantly until you get to the answer that you want.
Yeah. Well, let's get to some questions from our community. And a reminder that if you do have a question that you want us to ask on the next episode of Ask an Advisor, ask@equitymates.com is the email address. We've been speaking about cash flow a little bit, so let's start with this one. When talking to clients, what do you suggest in terms of cash flow best practice?
Similar to a number of the other guests that you've had. So having, buckets with accounts for specific purposes. Maybe I'll answer that by touching on a few mistakes that I see people make. So one of the big ones is they're just saving whatever's left over. And if you're saving whatever's left over, then that's going to give you absolutely no insight or clarity as to when you're actually going to be able to achieve your goal. Like if you're wanting to buy $1 million place and you need a 10% deposit, you need $100,000. If you know that you're saving $2,000 per month or $3,000 per month, it's going to be really clear as to when you're going to be able to get there. If you're just saving whatever's left over or putting money in a savings account and then subsequently taking it back out, that's going to give you no clarity as to when you're actually going to get there. That's certainly one that I see quite regularly.
Is that the pay yourself first concept?
Exactly right.
Where it's like when you get paid, there's a set amount that goes into your savings account before you start spending.
Yeah, automate it. Again, very similar to in line with your philosophy around automate as much as possible. Set yourself a weekly amount. Quarantine your fixed costs in a separate account. Save in a separate account, potentially with a different bank. So if you're down at the pub on a Friday and you need another bottle of rosé, it's a little bit harder to kind of get those funds out.
Although everything with instant transfers these days.
I know, that does make it a little bit more challenging.
Yesterday we looked at the top savings account interest rates in Australia, and the number one is I can't remember the name of the bank.
Maybank, isn't it?
No, I can't. Maybe
it's not
Maybank.
Ubank.
Yeah. And the rule,
I know what it might be, but I'm always nervous about saying specific.
Oh, really?
Anyway,
we're not nervous. We're just throwing that there.
The rules around this were obviously like minimum deposit, blah blah blah, but also it wasn't available on an app, and you couldn't. It also wasn't available on internet banking.
Yeah,
so
right.
it was just like
What? So they have branches?
I can't remember what it was, but it was like super locked up. Like you're not able to go down to the pub on a Friday and start transferring out for another bottle of rosé.
Yeah. Or start looking at term deposits. So that's not something that we were very interested in about 12 months ago. But given where interest rates are now, if you want to lock away those funds for a period, then you can get some really attractive rates on those accounts.
Although didn't you look at term deposits, and at least from the major banks, the term deposit rates weren't even as good as like...
It's still better to have it in the if you've
top
got the
savings
ING
account?
savings account.
Totally. If you're doing the 17 transfers and you've got the 3 cards and you tap it twice a day and all that kind of stuff.
No rules on term deposits.
It depends, right? Like if and again, what's the cost of having that money at call and then taking the money back out versus having it in a deposit, right? Like I did accounting at uni. I genuinely wish I did psychology. I think that would have the conversations we have about money is very much kind of I guess emotional based, which is why a lot of my questions are, how do you feel?
Yeah. So then, secondly, speaking of interest rates, with interest rates going up, is there such a thing as good debt, or is it all just bad now?
Good question. So, controversial view, interest rates aren't high, they're just where they were about a decade ago. We have come out, I know that might sound a bit blind, but I know that there's been considerable hikes and that naturally is having quite an impact on a lot of households. But, in terms of good debt, there are, without turning this into kind of a tax chat, like there are advantages around having negative geared properties. So, paying interest that reduces the amount of tax that you pay. But at one point, you want to be debt free, and that the concept of being debt free again does come up in conversations a lot, and I'll always challenge that based on where they're at and what their goals are. So if you're in your mid-20s and you've just bought a property and your whole focus is not just on being debt free, I'd argue that, well, then what happens when you turn 40 and you're debt free? Then do you start investing? So it's about taking a bit more of a balanced approach. Whereas if you are looking to, pull back on work and this is the forever home, then again, the focus may be more on that debt piece. So there still is some aspects of good debt, for want of a better word. Like you're not going to buy a place in Australia without some degree of debt, I would argue. Yeah. So you could class that as good debt, but be really, when I ask some of the people I speak to, what's the interest rate on your car loan? What's the interest rate on your, your credit cards or your personal loan? Often they have to go away and check. So make sure you're really conscious of what you are actually paying before you make any decisions around how you allocate that surplus cash flow.
So we had a question around insurances. So the question basically was, is all this insurance really worth it?
Yeah.
That was literally it.
I know that's a bit of a piece of string because it's so dependent on your life circumstances and stuff like that. But
yeah,
we'll ask it generally, and then maybe if we drill in, I know we're going to talk about superannuation a little bit later, but maybe if we generally talk about insurances and then we talk about super insurances.
Yeah, totally. So, and I'm going to answer this through the lens of who we work with. So most of our members, again, 20s, 30s, 40s. So fairly early on in their career, generally speaking, fairly healthy. The biggest mistake I see people make when it comes to insurances is they look into their, more often than not, their super fund to work out what insurance they have when they're trying to claim. So up until that point, they have no idea. They're like, I think I have something, which they are paying for from their super. And then if something does happen, only at that point do they then actually care about what it is looking for. So before you make any decisions around super, understand what you currently have and what you're paying for, what you are covered for and what you're not covered for. In terms of the key triggers that we see when insurance certainly becomes quite a conversation with our members, first, when they're looking to start a family. Second, when they've got debt, so typically purchased a property. And also people often, when thinking about insurance, go to worst case scenario. So they think of life insurance or total and permanent disability, never able to work again. In terms of my experience, again, reflecting on the demographic that we work with, most all the claims that we've assisted with have been income protection. So I'll give you a really good example. One of our members, pretty fit dude, he's 33, he's a cyclist, and he was hit by a car. So he was off work for 3 months full-time, and then he was off work, and then he went back to work part-time for another 2 months. What that meant was the income protection, so income was being paid to him on a monthly basis while he was off work, so he could continue to pay the mortgage, and it didn't have a huge impact on his household cash flow. So don't always just think of insurance as worst case scenario. Like, we insure our dogs, we insure our cars, like we're traveling, like, oh, we've got to get travel insurance. If you don't have an income, you can't pay for any of your other insurances. So just be conscious of that.
And so when you say the trigger is going to debt, that's not going to debt, but like a mortgage, you're going to go get a mortgage. You're saying you should definitely consider income protection insurance.
Yeah, so how are you going to pay the mortgage? Always think about what's the backup plan. Like, taking out an insurance policy is essentially transferring the risk. Like, even if you don't have a house and a property rather, or a mortgage, or you have kids or anything, if you're renting and something were to happen to you and you weren't able to work, let's say for 6 months, what's the backup plan? Can you move back? Emergency fund. Can you move back with the parents? Would you what's the decision there? So insurance then enables you, once that kicks in, to then for you to be a bit more in control in terms of what that looks like.
Now, correct me if I'm wrong, but in your superannuation, those are the 3 types of insurances you can get: income protection, total and permanent disability, and life insurance.
Yep.
And then outside of your super, the obvious one is health insurance.
Yep.
Because of the Medicare levy, once you're earning over a certain amount.
Yep.
And then it gets more expensive with that lifetime health cover loading as well.
Totally. Yep.
Outside of health insurance, are there any other insurances that you see clients sort of at our age, early 30s, late 20s?
Yeah. So so there's income protection, total permanent disability, and life insurance. There is a personal life policy that you can't, personal insurance policy that you can't get through superannuation, and that's called trauma or critical illness. So this was actually developed by an oncologist, which I believe is a cancer specialist. So what this particular doctor found was people were suffering a critical illness event such as cancer. However, they weren't able to claim on their total and permanent disability because they weren't totally and permanently disabled. They would in fact be treated and then go back to work. So they didn't meet the definition of total and permanent disability. So there is another policy, critical illness or trauma, which covers you for the main reason why people claim on that is cancer. So it's a lump sum amount, but it's paid out if something shit happens, but you do go back to work. So you're not totally and permanently disabled.
Now I'm just
it's a
about
minefield.
That can happen.
Yeah, let's move on from insurance. Like my main advice though is just make sure you understand what you do have, what you are paying for it, what you are covered for, and what you're not covered for.
Nice.
That's key.
All right, Glenn, the next one has come in from Emily. She says she's in need of a new car. Her work offers novated leasing. The question is it worth it, or should she look at a car loan with a reasonable interest rate?
Good question. So I'm not a car person. My advice is similar to our friend Scott Pape: buy the cheapest car your ego can afford.
Nice.
And I say that respectfully. Some people need cars, like, if you've got a young family, things like that. But for me, when I was living in the city, I just used Go Get. Really cheap, didn't have to worry about when it broke down, all of that kind of stuff. In terms of the option, so novated lease, yeah, it can have some tax advantages, but also acknowledge, like, if you buy, let's just say you go out and buy a $30,000 car, don't just think about the cost of the interest that you're going to pay or the tax that you're going to save. That $30,000 car in 2 years' time is going to be a $20,000 car. So I also want you to take in that $10,000 depreciation cost into account when thinking about purchasing that car. So there are pros and cons there are pros for the novated lease. Be conscious of, again, what rate you are paying on that. There are some tax advantages, but for me, my way personally has always just been pay for a car from cash.
As cheap as possible.
As cheap as possible.
Yeah. Nice.
So we had one question here that Bryce and I don't have a lot of experience with. It was around school fees, which...
Let's just say we have zero experience.
True. I've heard how high they are.
Yeah.
So we had a question around, is it a good or a bad idea to invest in bonds for school fees? And I guess there's probably 2 parts to this. One is if you've got young kids and you're looking ahead at school fees, and the other is if your kids are at school.
Totally.
Yeah.
So most of our members, their kids are not at high school because, again, they're 20s, 30s, 40s. However, chatting with advisors that work with, I guess, an older demographic where their kids are at high school, given that you can pay 10, 15, 20, $40,000 per year, per child, per year for school fees. What they have seen most of their clients do is redraw on mortgages. So they spend all of this time paying off their mortgage, and they then need to fork out $80,000 per year, which over a 6-year period, if it is just high school, is, $500,000. They're redrawing on their mortgages that they've just spent the last decade trying to pay off.
Wow.
So we have conversations with our members around schooling even before they've conceived their first child. So, and the reason why we do this is because we want to understand if private school is important for them. And there's no right or wrong. Some of our members really comfortable with public. Some of our members, they want to send their kids to the school that they went to. So what we do for those members that have kids, are wanting to send their kids to private school, we would definitely consider an investment bond. There's the main advantage of utilising an investment bond or an education bond is tax. So if you are in the highest tax bracket, any investment or even cash you have in a bank account naturally is going to be taxed at the highest marginal tax rate. Whereas using an investment bond or an education bond, it's actually capped at 30%. And you can also then take those funds out after 10 years tax-free. And it doesn't actually need to be for education purposes. It can actually just be for any purpose.
Wow.
The caveat to that is that 10-year period, right?
It's
you can take the funds out, you then lose the tax advantage.
Right.
So you'll have to then, if you're on the highest marginal tax rate, you'd have to then pay that top-up tax of the 17%. So it's a really, really good way to almost start prepaying those school fees. And the most common feedback I get from members is when we bring up the conversation around private schooling is they're not sure. Maybe they do, maybe they don't, but they want to be in a position that if they want to, they financially can. So that's where an investment bond still can be quite a favourable consideration, because even if the time comes and you're really comfortable with a local public school, you can then use those funds for other purposes.
How do you even buy an education bond?
So there's certain companies that, so it's a structure.
Right.
An education bond is a type of structure. In terms of the underlying investments, there's usually a menu of about 20, 30 different funds.
Right. So
within that.
It's not a listed product or...
No.
So there are like specialized providers that you go to.
Correct.
Yeah. Okay.
Yeah.
Do you need to do it through an advisor?
No, I don't believe so.
Okay. Cool. Yeah, it's a whole world that I just don't have a lot of experience with.
Totally.
For obvious
And it's
reasons,
a really cool one to look at, not just for that education purposes, right? But just reducing your taxable income for a lot of those for a lot of listeners that are PAYG. It can be really challenging to look at ways to minimize tax, but this is a way where you can invest and do it in a tax effective environment.
Nice.
Cool.
Love it. All right. We've got a couple on superannuation. So the first one, Glenn, is there a limit to after-tax super contributions?
There is. So there's concessional and non-concessional. So concessional is where you're able to claim a tax deduction. Non-concessional is after tax. So you can put those funds into super. And I believe bring forward, I think it's you can bring forward around or contribute about $100,000 post-tax now, and if you haven't done so, you can bring forward, I think, the last 3 years. So make a one-off contribution of $300,000, but then for the next 2 years, you won't be able to do so. So that might have increased. So definitely check the numbers around that. Given, again, who we work with, most of our members are starting families, buying properties, putting more money into super beyond what they can claim a deduction for isn't super front of mind for them.
Yeah.
Super front of mind. But yeah, you can put in additional amounts, but just double check that.
Yeah.
Yeah.
Nice.
The other question we have about super is one of the most common questions I think we get, which is should I be investing in or outside of super, and what are the considerations? Specifically, this question was, I'm salary sacrificing the max into superannuation. Am I better to invest in ETFs after tax instead? But maybe if you just give us some of the general considerations around the in super, out of super.
Yeah. So the very generic response is, well, what's the goal? What's the goal? What's the objective? The biggest advantage of super is tax. So by salary sacrificing, that money's going into your super. and not being taxed at your marginal tax rate. That's going to have huge compounding impact again over the long term. So again, we are having conversations with our members that are not retiring for 30 years, 40 years about making small contributions into their super. The downside is obviously you can't touch that until you inevitably retire. So our approach is one of diversification, and not just looking, when I refer to diversification, I'm not just talking about asset class, like international shares versus Australian equities versus property, but it's also about considering putting additional funds into super, considering an education bond, considering your traditional exchange traded fund stock portfolio, considering property. So big advocate of looking at making considerable additional contributions to super, particularly referencing that first home super saver scheme where there's caps and caveats to this, so look into it. But though if you're looking to purchase your first property, you could salary sacrifice and then get the tax advantages and then subsequently take out a portion of those funds to go towards your first home. But if you're going to the effort of making additional contributions to super, make sure you understand what you're investing in. So this is another thing that I see somewhat regularly. So people have heard, yep, awesome, I want to make more contributions to super. This is going to help me over the long term. Those contributions are being invested. What's it being invested in? What's the performance of the portfolio? What fees are you being charged? I love the fact that we've gone to the effort to be conscious and put additional funds in. Make sure you understand what those funds are being invested in.
All right. Well, next we're going to move to some investing questions and the classic, should I pay off my mortgage debt or invest more in shares? But first, we're just going to take a very quick break. All right, well, welcome back. We're with Glen from Fox and Hare, and this is our Ask an Advisor episode. You can hit us up at ask@equitymates.com for future questions. But let's get into the investing questions for today. The first one, Glen, is I'm earning decent money and trying to figure out my investing philosophy. That's a good one. What should I think about?
Good question. So investing philosophy is a very broad broad kind of spectrum. What are we trying to achieve? I'm always going to circle back to goals. But in terms of philosophy, I can answer that by sharing my philosophy.
Yeah.
And that is one of, I love property. I'm investing in real property. I love investing in the stock market. I'm investing in the stock market. I'm also really conscious of what my super's doing. And every single investment decision I make, I'm conscious of the tax implications. So it is a broad spectrum, and it evolves, right? So ask me 18 months ago, I would have not considered things like a term deposit or a high interest savings account. I'd be like, whatever, 2%, that ain't going to get me far when inflation is what it is. However, fast forward, I can get 5.5% in a high interest savings account, and I know that's a guaranteed return.
Yeah.
I put money in my offset account. I think my interest rate's around 6%. I know that I'm not going to, that's going to save me 6% in interest. And just a quick one on that, something that often gets overlooked, I think, is the fact that if you've got money in a high interest savings account generating that 5.5%, you then subsequently have to pay tax on that interest. However, if you've got funds in the offset account offsetting 6%, you're not actually receiving that 6% interest. It's reducing how much interest you have to pay. And the double win on that is because you're not actually receiving that money, you're not then subsequently paying tax on that money. So offset accounts are much more powerful than what they were, again, 2 years ago. If I was offsetting 2%, I wouldn't be that excited. But if I'm offsetting 6%, that's a very different scenario. If we, however, then broaden that to look at the longer term trajectory of different asset class, I also will be investing regularly into the stock market as well. So it is a very balanced act and a balanced play, but it's always about looking, and this is something we do a lot with our members, is looking at projections. So if I stick to this strategy, if I stick to this philosophy, say, where am I going to be in 5 years' time? What does that look like? And if that picture isn't what I thought it would be, then understanding, well, what do I need to then change now in order to drive towards and create a different scene?
Yeah. Let's get to the question that we always get asked.
Mm-hmm.
For those with a mortgage, should I prioritize paying off my mortgage faster and putting more money into the offset account, or should I be investing it in the stock market? I should clarify.
So where we're at now, where interest rates are, I definitely think there needs to be, I know there needs to be much more focus on debt because of, paying 6.5%. Whereas if you look at investing in the stock market, you could even just, passive index funds, if you look over the long term, you could argue you might outperform that 6% or 6.5%, but the outperformance is much less than what it was not that long ago. Again, I want to challenge that just paying off debt, although it's not a bad strategy, it is a fairly conservative one as well. So if you're in your early 30s and your whole focus is just keeping as much money in that offset account as possible and paying down that debt, you've got to then think, okay, well, if you're then going to be debt-free in 10, 15 years, then what? Do you start then investing then? So it's about, I genuinely do believe it's about having a balanced approach and understanding, if I continue on this current trajectory, where am I going to be?
Yeah, I think that's an important one. Like, you don't want to leverage yourself so much that you can't continue to build wealth outside of your house.
Correct.
Because I think then you're just seriously
Well,
concentrated.
yeah, then if you're 40 and you've paid off your mortgage, you're not liquid.
Yeah, exactly.
And then what happens? Then you start investing, and
I feel like
that,
your house.
Yeah, and if it's your home, tax free. But it's a really good call out. Like, if you turn 40 and you're debt free, you've kind of missed out on the opportunity of establishing that regular investment strategy or putting additional funds into super that could have saved you tens of thousands of dollars in tax.
There's just so much to think about.
I know.
Anyway, that's probably today's episode.
A couple to go. So what are the steps to set up a family trust and invest through it?
So the first point of contact would be engaging the accountant. So I'm an accountant by trade.
Sorry, can we take a step back before we get into
Sure.
the practicalities of it?
Sure.
Like, pros and cons of family trusts. Like, is it something that we should be thinking about? Bryce has a fair bit of wealth tied up in the Caymans. So but like,
Dude, I said not on air.
but yeah, like, is it worth it? And then how do we do it, mate?
Yeah, good question. So is it worth it? So it depends on your circumstances. So to determine if it's worth it is to understand the costs of running these things. So it is going to set you back a couple of grand just to set up a family trust before you get started. And it's also going to need to lodge its own tax return on an annual basis. So, and then there's potential for audits and things like that. So there's a lot of costs, kind of not too dissimilar to a self-managed super fund, right? Like there's costs of running these different types of structures. In terms of how to set it up, so the first point of contact would be the accountant to actually do the practical side of things. In terms of where we get involved, so we work really with our members that do have a family trust or are considering a family trust. We'll obviously work very closely with their accountant. The main advantage, there's probably two key kind of call outs. So first, for business owners, a lot of business owners do have family trusts because they're trying to quarantine their business wealth from their personal wealth. So if something were to happen in the business, then there's a disconnect between the business and their family home. So there's a degree of asset protection. The second, which is certainly something that we talk to, is the tax advantages. The way that the structure works is you can distribute the income that's generated from the investments within that family trust to the beneficiaries. So if you're distributing that income, so say you're generating, $10,000 of income per year through the trust, you can distribute that income to a lower income earning beneficiary as opposed to the higher income earning beneficiary. So there's a bit more flexibility in terms of how you allocate that income. And obviously allocating it to the lower income earner essentially means that income will be taxed at their marginal tax rate. They're on the lower marginal tax rate. And the end effect is the household then inevitably pays less tax.
Yeah.
But in terms of, we would only really consider a family trust, one, if there's one already established, because there's a business involved. So there's one established, you're paying the costs, you may as well utilize it more broadly. Two, if there is there's probably needs to be a couple of $100,000 before these things really start, in my view, to make sense purely from a cost perspective.
So final question we got through from the Equity Mates community. This is another very common one. Who is the best stockbroker to go with when you want to do a set and forget index fund investing strategy?
So they're talking about, I'm assuming they're talking about like a platform to use. So I will mention names. This is not advice, but one that we see a lot of people use that many of the listeners would be familiar with is Raise. So that's a platform, obviously, micro investing, funds go in. So it's a good, I've got a little bit of a love-hate relationship with Raise.
Okay.
So I love, if anyone from Raise is listening, I love the fact that it's got people engaged
active,
with investing and active in investing that's felt it's not available or accessible to them. So I love that Raise has made that accessible. The challenge that I have with that is more often than not, for those that are invested in Raise, they don't know what they're actually invested in. And I think there's a missed opportunity there from the team at Raise to really educate their customers in terms of what is the underlying investment, what companies are they actually invested in, how do you make money from this thing. So a bit of a love-hate. Some of there's some really cost-effective platforms. So I believe Vanguard just bought out a personal investor platform. So you know, looking at that kind of traditional passive index, I believe, I haven't researched it myself, but I believe it's fairly low cost as well.
Yeah.
So that's certainly one that comes front of mind.
Nice. Well, Glenn, thank you so much. Covered a lot of ground there, and thank you to the Equity Mates community for sending in all of those questions. A reminder, ask@equitymates.com, and we'll make sure that we include your questions in the next episode. We also have a weekly email that we answer one of the community questions. We actually get the advisor to answer, so Glenn will be coming up with that if not already. So make sure you're subscribed to that. You can do that at our website, equitymates.com. Glenn, if anyone listening has really enjoyed what you've had to say, where can they go to find more info on Fox and Hare and a bit about what you guys do?
Yeah, the easiest place would just check out our website, foxandhare.com.au. Proud certified B Corp as well for the listeners that are across what that certification means. So yeah, happy to have a chat to anyone. I'm really conscious that advice can be feel like it's just for old rich people. We're breaking that notion.
Nice. Love it.
And you did say the first meeting was free?
Yeah.
Earlier?
Happy to have a chat with anyone. The first meeting is really about just understanding where you're at, what you're looking for, and sharing with you a little bit more about us.
Great.
Nice.
No obligations. Check it out.
Now, every year here at Equity Mates, we have an Expert of the Year competition or Guest of the Year. And it really is just a chance for us to celebrate everyone who gave their time and came on the podcast and shared their knowledge. Now, as a guest of the podcast, you're automatically in the running.
Love that.
So as a final question, can you leave us today with maybe a piece of advice or content recommendation or something we should go and do and implement in our financial lives? Just one thing to leave us and everyone listening with.
I'm quite competitive, so I'm really hoping this is a good answer. Think about the question that I asked, and I ask in that first chat with everybody. And that question is, how would you rate your overall financial world? And then think about whatever your answer is, think about what's going to then enable you to move forward. You know, really setting yourself up for the future is about making really conscious decisions, and that can be really overwhelming. So simply break it down. If you're a 6 like Bryce's homework is to then go away, think about what's going to get him to a 7, and then implement that.
Nice.
Love it.
Love it.
Well, good
luck.
What would you rate yourself out of 10?
True.
I would rate myself probably about a 7.
Okay.
Not because it's just more than Bryce, but because I'm across everything. But there's just a lot of moving parts, so there's just always something that needs to be done. So it's constantly looking at, okay, well, we just bought a house, 2 months ago. Okay, how does that work with the considerable amount more debt we've got? So yeah, probably about a 7, and just constantly reevaluating.
A good reminder that even professionals are still figuring it out. And,
it's a journey.
Yeah.
It's a journey.
Well, thank you so much, Glenn. We really enjoyed that.
Thanks, mate. Appreciate it.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.